Hello, I'm John Cogan, the CEO of Performative, the leading platform for professional development across the Office of the CFO. I would like to welcome everyone to today's event entitled A CFO's Guide to Building a Subscription Revenue Portfolio. I would like to thank our sponsor, Vindicia, whose commitment to thought leadership in this realm helps us make today's educational webinar possible and delivered at no cost to the participants. Companies with a subscription business model expect to see benchmarks as well as intelligence around top performer metrics and KPIs in order to understand the business and its most effective growth strategies. Longtime CFO Mark Resnick will share his financial insights and best practices to thrive in a subscription-based business. He'll be joined by technology expert Doug Smith, who will highlight how successful companies are transforming their subscription companies. We have a few learning objectives for today's event. After today's event, you will be able to list KPIs of a robust subscription revenue portfolio, recognize industry benchmarks for acquisition, churn, ACLV, efficiency, and more, identify best practices among leading subscription businesses, and identify strategies to mitigate churn, an ever-present and oft-ignored factor in revenue loss. We have a few notes from Performative around today's event. First off, the slides you will be seeing are available under handouts on your GoToWebinar control panel. So if you want to grab those, download them, print them out, what have you, open up your GoToWebinar control panel, and towards the bottom you'll see a section called handouts. You might have to hit the plus next to that word, and then they're available for immediate download. Also, within the next 24 hours, we will send you an email. That email will have links to you got it, those slides, and to a recording of the presentation, which we are making right now. We are offering CPE for today's event. So if you would like CPE credit, continuing education credit, simply take all 3 polling questions, which will come throughout the event, and remain for the duration of our hour. The CPE credits will show up in your My CPE area if you are logged into Performative. If you have any questions at all about CPE, just email us, cpe@performative.com. We'll take care of you immediately. We would like this to be an interactive event. We have set some time aside for questions towards the end of today's webinar. So please do ask questions. Once again, I'll refer you to the GoToWebinar control panel. There's a section there called questions, and you can simply type them in. Note that no one will see your question other than myself, so they're anonymous, don't worry. But we'd love to see your question, and the earlier questions tend to have a better chance of getting asked. So ask your questions early, ask them often, and then we'll do our best to get to them all during the Q&A portion of today's event. Finally, at the tail end of today's event, you will be prompted to take a short survey. We greatly appreciate your feedback. It helps us in our attempts to do better every time out. So please do let us know what you liked, what you didn't like, or maybe something we didn't do that we should have done. So that feedback is much appreciated. Plus, in that short survey, we make it very easy to request a connection to either of today's speaker or our sponsor. So stick around for that. Thank you so much. And we want to welcome everyone to Performative, or welcome you back if the case may be. Performative is the leading professional development resource for every member of the Office of the CFO, combining on-demand courses in Performative Academy, over 10,000 discussions in our community, and over 200 webinars like the one you're seeing today. So thanks so much for joining us. We greatly appreciate having you on board, and we hope you have a great time learning today. We certainly have a wonderful program in store. And that actually brings us to the reason we're all here, which is to learn about a CFO's guide to building a subscription revenue portfolio. We've got 2 fantastic speakers who are going to be helping us on this journey today. I'm going to introduce them right now. First is Doug Smith, Senior Vice President, Technology Expert at Vindicia. Doug has over 20 years of experience in technology development and professional services in enterprise software and telecommunications. His primary area of focus is professional services practice development, as well as enterprise scale integration strategies. Joining him today is Mark Resnick, Chief Operating Officer and Chief Financial Officer of Vindicia. Prior to joining Vindicia, Mark served as the Chief Operating Officer and Chief Financial Officer of Transera Communications, an enterprise-class on-demand contact center software company. He also was the Chief Financial and Chief Operating Officer at Core Metrics, a leading on-demand web analytics and marketing optimization solutions company. Mark and Doug, great having you guys on board today. Thanks so much for joining us, and it's absolutely our pleasure to have you.
Great. Thank you very much for having us. Good morning, good afternoon to everyone. We're excited to be here today and walk through the agenda that we've had built out. The first two bullets, I'm going to address those. This is Mark Resnick, and then my colleague, Doug Smith, will address the subscriber retention best practices and how innovative brands are building their portfolios given his interaction with our customer base on a day-to-day basis. So we want to move on to the challenges of the CFO. When we talk about consumer subscription business models, there's a couple of bullet points that I always like to highlight when I'm talking about some of the key challenges. The first and foremost is near and dear to my heart, and that's the upfront cost to establish and operate your business on a 24/7 by 365 basis. Some people kind of overlook this component depending on the size of the business, but whether you host or you outsource your infrastructure, you need to have all hands on deck 24 hours a day, ensuring that your service is up and running. Because at the moment when one of your customers comes to a website, or potential customer comes to your website, and they want to subscribe, if you're down, you just lost them. And in several instances, whether you're a smaller provider of services or a large, these costs can be significant. And until you get enough subscribers, you'll actually be underwater with respect to your costs. So you've got to understand these costs and how to scale your operation. Bullet 2 is a significant component of the business challenges that one has to address. It's the substantial investments in acquiring subscribers. We all know and love our marketing teams, and they have to make decisions on where to spend the assets that you provide them, whether that's AdWords or in the website or through channel programs or otherwise. But kind of the first two bullet points can apply to any business model. Understanding your costs and understanding the cost to actually gain revenue, gain customers. When you talk specifically about the business challenges of a consumer subscription model, you get into customer retention at a far deeper and more intricate level than you would in any other business. And I think that you have to address a couple of significant areas. One is voluntary churn versus involuntary churn. And I think we all understand voluntary churn. A customer has decided to opt out. The involuntary churn is really the area that we try to focus on organizationally and when we work with our customers and help them out and provide expertise. And that's understanding what's happening in the payment card network. Why are we seeing between 10 to 30% of all subscriber transactions fail? That's a big number. Obviously, it depends on the industry. Just to give you perspective, that's usually a reflection of the demographic of the customers you have for your subscription business model. If you've got consumers, young, lower credit worthiness, you're going to see a larger churn, involuntary churn number than, per se, how about a financial services company that's catering to a demographic that has more capacity within their card vehicles to pay the recurring subscription fee. But the cost to retain failed subscribers is far less than finding new ones. So the key for us is really to understand how do we address involuntary churn. I think it's important to note that in a subscription business model, we have a significant advantage in that we can drive growth through our understanding of data. We have 4 graphs here on this page that are presenting some different elements that we see in subscription business models. The first in the upper left-hand corner is just understanding revenue by region. Why? Obviously, that'll define and drive your investments in your marketing spend. Upper right-hand corner is actually a cohort of subscription lifetime. So we can understand if different programs are leading to longer customer lifetimes. The lower left-hand corner is a retry success example where we see the initial attempt on a credit card receives an 87.1% success rate. Then we have a retry logic that adds 1.5 points, almost another 0.5%, and we can see obviously diminishing returns as we go through a retry cycle. The last is really my favorite graph because this is where it all resides. This is the compound effect of subscription revenue models. And we can see the blue in this particular graph is new subscribers, whereas the beige is those existing subscribers recurring and renewing. So in my parlance, I refer to this as an annuity stream that we've built, and that's the way we want to talk about it. When we think about some of the dynamics of the subscription recurring business model, we think about acquire, retain, and expand. I think most people can get their heads wrapped around those pillars, and they focus most of their attention on the acquire and the expand. So let's just dive into those really quickly. On the acquisition, you need to make sure you're offering products that are priced correctly in packages that consumers want and in ways that are culturally relevant, whether that is payment methods or language or otherwise. So certainly your marketing team is focusing on that acquisition element of your subscription business model. The expand is enabling additional purchases to your most loyal customers. You know, our data shows that loyal customers of your product may be willing to pay anywhere from 20 to 70% more if those services were optimized or provided additional services for them to purchase. So this is obviously the gold carrot that exists out there for folks is if you can acquire customers at a particular price point and then upsell them as you extend their client lifetime, that is a fantastic life cycle process. But in the middle there is retention. And this is one where finance folks are most aware because it's absolutely quantifiable. Doing retention well is a measurable outcome that can have a tremendous impact on a company's bottom line. And that's what we're going to focus in on today. Now, we already showed you this particular graph 2 slides ago, but I wanted to just talk about, you know, the cost to add subscriptions through marketing is a fairly well understood through most organizations, and it's an industry standard process, if you will. But the graph here shows the acquisition pace of a subscription business. So this is actually one of our clients. And I want to point out that although there are some apparent bursts in new clients being acquired, the spend over those periods of time was relatively constant. The attraction of the subscription model is obviously the new signups that stay with you and build up the beige component of this particular graph. If subscribers stay on the platform, revenue from newly acquired subscribers is obviously rapidly outpaced by the revenue from the existing subscribers, hence retention. Go ahead. Right now, I'm going to turn this back over to John for our first polling question.
You got it. This is the first of 3 polling questions, and as you'll see, we'll give you 30 seconds to answer this. We'd love everyone to answer, whether you're here for CPE or not. As you can see, this is not a test question. This helps our speakers today know more about the audience. So we'd love to know more about the audience here. Your responses are anonymized, by the way, so no one else on the call will know what your vote is. The question here is, what is the primary challenge your organization faces with its recurring revenue business? So this will be interesting to see how this lays out. I'll leave this open for another 5 seconds just to make sure everyone can get their licks in here. And let's go ahead, move to close it out and share it out. And gentlemen, what do you think about this? We've got a couple leaders here.
This is Doug Smith. So, you know, this is certainly in line with what we see when we talk to clients. There's always a lot of focus on acquiring new subscribers and increasing their revenue. And, you know, to my mind, folks put a less emphasis than is necessary on retention of subscribers. As Mark was pointing out in the previous slide, that ability to compound the growth month over month, year over year with your subscribers is actually the most cost-efficient way to grow a subscription business.
Yeah, and I'll just add to this point that I think that most newly formed or developing subscription companies have a tendency to focus on acquisition. That is the #1 metric that they put in front of their peers, their management team, and then the board. But over time, the transition to the focus of the retention becomes an imperative, because when you get to a point where you are not adding more new subscribers than you are churning in a month, the problem becomes ever glaring. So as a finance professional, if you can focus the attention on this earlier in the process, you will help your company grow. So I'm going to take a little transition right now to forecasting subscription revenue. And I'd love to tell you that there's a silver bullet out there, but there isn't. It's just basic blocking and tackling. And I'm not saying that it's easy, but it's certainly a doable task. So the first thing we have to do when we're forecasting subscription revenue, which is understand and forecast your subscriber base. You've got current subscribers, or if you don't, you're just going to move on past subscribers to new subscribers. But if you've got existing subscribers, you should have that metric available. You're billing these folks, you have that information. It's where you get to new subscribers where a little bit of art comes in. This is where I like to go get the crystal ball out of the closet, put it on the desk, and take a moment to think about the various variables that come into play here. Obviously, the first and foremost is kind of marketing spend and the effect of that spend. Because you can spend a lot and not have it be very effective, but you need to understand what those metrics are, try to track them. Initially, you're going to have to make an intuitive assessment of what that might be in the early stages. But you can certainly come up with a new subscriber metric that you're going to track. The other factors, though, are kind of sometimes more difficult. Social factors. If you're a particular company, if you're a gaming company, and all of a sudden, your game becomes the hottest thing out there in Instagram, Snapchat, or for us old folks, Facebook, then that could influence those spikes that we saw on that compound revenue worksheet. Remember, the spend of our client was fairly constant, but there were some bursts out there, and those activities are hard to forecast, but you've got to think about those and understand the dynamics of the environment you're in. And again, unfortunately, churn is a reality of any business. Voluntary churn, that's a controllable element. It's a multifunctional issue that finance can drive. It's talking about the quality of the experience, the quality of the service, the depth of the service. When your customers opt out of your subscription service, what do you do? Do you ask them for any feedback as to why? Do you have any outreach to try to bring them back? What are you doing there to try to understand and affect voluntary churn? Involuntary churn, though, is a little bit more difficult. That's a payment failure. That has to do with your retry logic. And, there's some industry expertise that can be brought to bear that will help companies understand how to implement programs and address involuntary churn. Now, understanding your subscribers is important, and we're going to go one layer deeper. And this really depends on the particular organization and the subscription revenue stream, the consumer products and services offering. But we normally need to talk about an average revenue per user, or revenue per user as ARPU, either way you say it. When you're talking about ARPU, early stage companies may have a single or a small number of product offerings to calculate what ARPU is. If you're fortunate enough to have one price point, ARPU is a very quick and easy calculation. But most companies find out that they have not just one billing plan, but more mature ones, tens of thousands of billing plans. And those ARPUs are more difficult to determine. There could be more statistical data upon which to ascertain and develop that estimate, but it's there. So you need to be able to drive what is that average revenue per unit, per client. A combination of successful client forecast and an ARPU calc will result in top-line accuracy, which in any business is a key to success. If you know what your revenue streams is going to be, I'm going to trust that financial professionals can make the decisions around expenses to optimize the outcome that they're looking for and to ensure that the bottom line and the checkbook are held intact. And when we move to the next level, kind of beyond growth and subscribers and revenue, we all know growing the top line, monthly recurring revenue, is an important determinant in driving company value. But we really can't just stop there. And I know in the previous slide, I know financial professionals will make good decisions around the expense side of the equation when thinking about an overall P&L of a business. But it's equally important, and even more so, to dive in on how efficiently growth is achieved. The cost of growth has to be well understood. And there are any number of SaaS metrics that one can use. And quite frankly, it's pretty easy. Go into a search engine, put in SaaS metrics, and you'll find out how many experts exist right now around SaaS metrics. You'll have pages upon pages. I wouldn't recommend going to all of them, but you'll probably find a few that resonate with you where you can go in, read about those SaaS metrics, and make the determination of your particular company, industry, circumstances, which metrics are interesting for you to manage, monitor, and drive your business on. One of those that I will highlight, however, is to look at average customer lifetime value, because this is a driver to most all subscription business models that I know. Now, the top is a snippet that is a very complex calculation of average customer lifetime value. It's actually above my pay grade, so I prefer the one down below, which really looks at the average monthly revenue from a customer versus the average monthly cost to serve that customer times the customer lifetime. Simple. Gross margin. What am I driving my business with? Because it's that gross margin line item that allows you to cover the G&A, SG&A costs of an organization. And, I think when you first start a consumer subscription model, the biggest question is the customer lifetime. Obviously, we've got some churn statistics. We've mentioned some churn numbers. It's all about ensuring that you retain that customer longer and longer, because the cost to acquire that customer were high. If you're able to retain that customer and have a positive gross margin for an extended period of time, you will have a successful subscription billing model, and you will be a successful company. I'm going to turn this next section over to my colleague, Doug Smith.
Thanks, Mark. So I'm going to talk a little bit about both the practices, what goes on with our clients, and what we see out in the market, as well as some of the kind of key terminology and ideas. Mark touched on both voluntary and involuntary churn, so let's dive a little bit deeper on that and talk about what causes that type of churn. Voluntary churn, as we said, this is a consumer who says, I don't want to subscribe to this product anymore. Now at a very basic level, what is that? That's somebody saying that they're not getting value out of your product. There are really only a couple of ways to address that. One is to invest in a lot of R&D, bring new product to the market, and enhance the capabilities. The other is to change the price point of your product. Those are fairly straightforward things to go and do. Some of them are very expensive. I don't know about your organization. When I ask our CFO about investing in our product, he kind of looks at me and goes, really? Are we going to spend more money? So we're always looking for ways to help our clients extend the customer lifetime and increase customer lifetime value in ways that don't require extensive R&D investment, which really gets us over towards involuntary churn. So another way of describing this involuntary versus voluntary is active versus passive churn. Active churn is that voluntary churn. Somebody's taking a step to cancel out. But then passive churn is when somebody's billing payment instrument is failing at the time that you're trying to collect payment. There are a lot of things that you can do to decrease your overall passive or involuntary churn. And so we're going to hit on a couple of those highlights today. The other thing that we're going to talk about is actually this middle section, which I call induced churn. This is churn that is caused perhaps by something you did or didn't do that then leads to further breakage. And it's sort of a hybrid. It sits in the middle, but you'll see where it kind of fits into the overall picture in a minute. Okay, so eye chart time. Everybody likes to read lots of text. I'll pause and everybody can read every single line of this slide. Maybe that's not the best approach. So there's a lot of good data here, but let's just pick a couple of these to zero in on and talk about ways to reduce overall churn. One of the things that is very important is knowing when to reach out to your customers. When should you reach out? When do you want to talk to them? And when do you not? I am commonly asked a question by almost every one of our new companies that comes onto the platform. They like to ask, hey, shouldn't I be reaching out, sending an email to somebody when they subscribe and their payment has failed the first time I go out to bill that credit card? I can tell you that in almost every single instance, the response to that question is no, you should not. If your billing system is well configured, if you've got all the right capabilities in place, then you don't need to reach out to somebody at the time that initial billing fails. You should have in place sophisticated retry logic, optimizations for day of week, being able to bridge a payment period. There's a bunch of different things that you should be able to do that will allow you to turn that failure into a successful transaction. If you reach out to the customer at the first moment of which there is a payment failure, then really what you're doing is you're poking them. You're going to remind them, hey, gee, Kevin, you're over your credit card limit today, and by the way, you've got a subscription to my website. Well, the first thing that Kevin's going to think about in that situation then is, oh, geez, I'm out of money. I need to go cancel that subscription because I can't afford it anymore. So what you want to do is to, instead of reaching out right away, let's go and look and see if there are other ways that perhaps we can get that transaction to go through successfully and retain that person as a subscriber. The other one, another kind of common issue that we have or that we like to talk to folks about is when someone is actually leaving, what do you want that experience to be like? There are some competing schools of thought on this. I will tell you that our experience with our clients is very clear about the best way to go and do this. There is zero ambiguity in this. And there are a couple of really great consumer names out there that everybody's familiar with that really highlight those behaviors. Comcast and Netflix are both in essentially the same business. They provide video content for entertainment purposes. These two companies have absolutely different reputations in the marketplace. Comcast became very famous when somebody released a recording of one of their customer service calls where a call agent kept somebody on the phone for over 25 minutes and harassed them as they tried to cancel. Why would you want to leave our service? It's the greatest thing in the world. I'd just like to leave. No, I really need to understand why. That is not the kind of customer experience you want someone to have. It is going to leave a very negative taste in their mouth. They are going to be very unhappy by the time they finally do get off your service, and they are likely to never come back. On the other end of the spectrum, you've got companies like Netflix. There's actually a Harvard Business School study that was done about the retention practices of Netflix. Netflix makes it very easy for you when you want to leave. You go onto the website, you log in, you click, I want to cancel my subscription, and it shuts it down. They actually retain all of the information that was in your account at the time that you left. Your whole queue of all the movies that you wanted to watch is all there. It's all kept in the exact same order. All the information is retained so that at some point, if you decide you want to come back to the service, you can step right back into the experience that you had previously. That is a far better consumer experience. What does this look like at a practical level for folks running a subscription business? It means do basic things like make it possible for someone to care for their subscription directly from your website on good on good self-service pages. It should be intuitive. They should not have to dig through 9 pages of fine print to find the place where they want to opt out. Make it easy for them to go and cancel. Send them a nice note afterwards and say, thank you very much for being on our service, and we hope to see you again. You will have far better results that way, and you'll avoid a bunch of ancillary costs like chargebacks and bank dispute fees that you would otherwise encounter. One of the other things that you can do, though, when somebody is leaving your subscription business is to implement retention offers. I'm going to use an example from one of our clients here, which is NASCAR. If you're unfamiliar with their digital offerings, you can go to the NASCAR website and subscribe to a package that they offer where you'll be able to have access to a lot of exclusive content. In-car cameras, you can listen to, you can watch the race from the driver's point of view. You can listen to the pit crews talking to the drivers. There's a whole series of exclusive content that they have. And they make that available on a subscription basis. Now, I didn't realize this when we signed them up as a client, but they actually have a season that starts at the beginning of February and it runs all the way through November. So it covers most of the calendar year. One of the challenges that they have, though, is that if your driver is no longer being successful, they're not winning a lot of races, then those folks tend to opt out and leave the service. So here you've got active churn that you really aren't going to have a lot of control over because sooner or later somebody's got to win the race. So what NASCAR did was they asked us to implement a series of retention offers. When you go to opt out, it's fairly straightforward on the subscriber self-care pages as to, how do I cancel my subscription? That's easy to do. But then they ask you a quick question. Hey, why are you leaving? You can skip that question if you want, but if you answer the question and you say, hey, my driver's not doing well, or you give a couple of other responses, they'll offer you a retention package. They'll offer you the ability to continue your subscription at a lower price point or to downgrade from all the content to a subset of the content. In doing this, what they achieve is they've extended your relationship with them so that you possibly will renew again next season, and they're getting additional money from you. So they're increasing that customer lifetime value in a couple of different dimensions on the graph. So by implementing a couple of really simple screens here and a fairly straightforward business process, they're able to take what was churn and turn it into retention and extending customer value. All right, so let's talk a little bit more about involuntary churn because the things that we've talked about so far really have to do more with the active churn, the voluntary churn. But what about involuntary churn? The payment industry, the banking industry in general, would like us all to think that banking is rock solid and everything works exactly as it's supposed to every single time. The reality is that the payment card network itself is very fragile. The infrastructure has been around for about 40 or 50 years in its current iteration, and it is subject to all the challenges that you have when you've got all these different players in the stream. You've got the issuing bank that gave out the credit card. You've got the merchant bank. You've got the payment processors. You've got the card associations. All these folks have to have seamless in order for any transaction to go through. As a result, there are all kinds of strange things that can happen that are going to cause card failure at the time of the subscription renewal or at the time of a transaction. One of the most classic things is that somebody's briefly over their credit card limit. Maybe they've gone out and made a big purchase. Maybe they have gone to a hotel and the hotel is reserving a large amount of their credit limit. But if you're running a subscription business at $10 a month and you're trying to renew that subscription and someone has checked into a hotel, you may find that you're not able to get a renewal on that subscription at the time that you're trying to process it. There may be things where you've got bank issues. Everybody's familiar with the data breaches that are happening. It seems about every other month we've got a massive data breach and there are millions of cards out in the clear, and then of course an issuing bank is in the business then of having to push out new credit cards. You need to be subscribed to things like Account Updater, so that you are getting that updated card information. Our experience is there are several different ways to do this and to do it effectively. As I talk to our clients who are coming on board, they typically are very aware of, if I get a payment card failure and Joseph's card failed at the time that I tried to renew it, then I want to go out and request the renewal on that. There are actually a couple of other things that we advise our merchants to do in terms of processing those in advance, going out. If I know that I'm going to bill Joseph's card next month or in the next 14 days, maybe this is the time I want to go out and request that update. If I have a product that is a long duration product, meaning it's an annual renewal, or it might even be a biannual renewal, you want to go out and touch those cards more often. Even though I might only want to renew this subscription once every 12 months, we advise our clients to go out and request the account update on those cards at least once every 3 months. The incremental cost you incur there is very, very small compared to the value of saving a subscription, particularly if it's a high-value subscription. There are a number of other challenges that come up. I can talk about a couple of others, particularly the last one here, banks misidentifying recurring subscriptions as fraud. One of the things that is going on with the increased level of active fraud in the network, the number of hackers that are out there, is that banks are getting more stringent in approving transactions. So that is usually a matter of working carefully with your payment processor and with your merchant bank to make sure you're in the right merchant classification code, the MCC code, so that your transactions are properly viewed as they are coming through to be processed. Some additional best practices. So I'm going to talk about a few things here that you can do to maximize your renewal revenue, and I'm going to focus primarily on monthly revenue renewals because that is actually where the bulk of consumer subscriptions are. Just as a data point, if I look across our whole portfolio of clients, about between 75 and 80% of the revenue comes in on monthly products, and with the remaining 20% coming in on annual products. So if you are running a monthly subscription business, you have the ability to do retries for payment failures. We recommend that clients spread that out over a 25-day period. There are limitations. There are rules about how often you can do this. You need to be compliant with those rules, but you should definitely spread out your retries. I have talked to clients coming on board that actually had been previously, they were running 5 retries in 4 days. I've had clients come on board and say, oh yeah, we try every other day for 90 days. When we look at the data for those kind of behaviors, it does not reward the merchant, and it's actually contrary to Visa regulations. So what you want to do is make sure your retry logic is consistent with the regulations, and yet it maximizes your ability to capture revenue. Why is that 25-day period important? Well, because one of the biggest benefits you get there is that it actually spaces out your retries so it crosses over a payday. Almost everybody who collects a paycheck gets paid either every 2 weeks or twice a month. About 60% of the people in North America get paid every other Friday, with the balance then, of course, being twice a month. What you want to do is you want to space your retries out in that 25-day window so that you've got it a good chance that someone gets their paycheck, they get a deposit in their bank account, they've paid their credit card bill, and now there's some available credit to go out and take a payment. I mentioned Account Updater on the previous slide. That is an important tool to use. It is important, though, to know what you're going to get out of Account Updater. Processors and merchant banks will tell you that Account Updater is the be-all, end-all. I can tell you from statistical data, Account Updater will give you approximately, it'll give you somewhere between 0.5% and 0.75% in revenue lift. It is not going to save a failing business, but it's certainly nice revenue to have, and most CFOs that I know will do anything to squeeze a little bit of extra money out of the revenue stream. So paying for Account Updater is a worthwhile service to use. And yet I am surprised at how many clients we have that come on board who have not previously implemented it. And I'm talking about folks that are running multi-million-dollar subscription businesses. And we say, okay, so what's your Account Updater configuration? And they say, oh, we never bothered to implement that. We don't think we get a lot out of it. Holy cow. Well, that's kind of free money, guys, or as close to it as you can get. So make sure that you're implementing Account Updater and that you're doing it all of the different possible permutations to maximize the return from it. Day of week premiums. One of the things that we see is that given the way that folks get paid, different subscription businesses will see a boost on particular days of the week. We do a lot of data analysis for our clients and see that certain business types, certain demographic groups, you will see more favorable returns on, say, a Friday, Saturday, or Sunday. And if I got paid on Friday, there's a good chance that I went out and drank most of my paycheck, and so by the time that Wednesday rolls around, there's no money left in the bank to pay my credit card bill. So taking advantage of those kind of capabilities and having the infrastructure in place to do it is an important way to maximize your return. The last one here, optimize settings for a processor and payment method. I'm going to confess, this one is a challenge for small merchants to do, or even mid-sized to larger merchants. We process about 250,000 transactions a day, and so that gives us a tremendous amount of data to look at. What we have done with that is examined each individual payment method, each individual processor that we work with, and we have optimized all the flags and settings that you make when you're making those API calls to the processor's network. We've optimized all those settings so that we're getting the best possible result. It does require a lot of data in order to be able to do this, and this is a case where folks who are either running a very large business or working with a large service provider definitely have an advantage over the small to mid-sized companies that might be just kind of starting up and perhaps don't have that same volume of data coming through. But it is worth it if you have enough data to do proper analysis, then it's definitely worth the effort. All right, so I want to talk a little bit about a couple of our clients and some of the interesting challenges that they've faced in this market. We do a lot of work with DirecTV. We run several different properties for them. One of them is their over-the-top offering of NFL football. If you are a college student, if you are living in a high-density urban environment in an apartment building and you can't get a DirecTV dish, you can still get access to the NFL Sunday ticket games. They offer a recurring subscription product to pay for this, but because it's the football season, they have some unique requirements. They want to be able to bill you. You can either sign up for this with a single annual payment at the beginning of the season, but if you're selling to college students, they sometimes don't want to be able to have to shell out that kind of money all at once, so they want to have a monthly subscription. The NFL has some very stringent requirements around their content. They're licensing it out. That means that DirecTV, as the vendor, has to pay them on a regular basis. So you kind of hit this, what's the sweet spot of my recurring logic need to be? We work closely with DirecTV to tailor their logic so that they struck a good balance between making continued attempts on a failed credit card and yet not allowing somebody to have extended access to the content if they weren't making payments. So that was a case of really taking advantage of all the different capabilities in the platform to optimize the retry success and yet balance that against how long somebody should have access to the content. This graph of the retry logic, so this is a really good example. Mark talked about this earlier. Seeing that high success rate on the initial attempt, that's certainly, at 87%, that's what I would classify as a good success rate for somebody who's running a good content business. What you'll see here is that the retries have been spaced appropriately so that they're getting a good return on it. If you're looking at your own business and you want to know what you should be getting, this is pretty much a picture-perfect or a very classic revenue lift curve that we see with our clients. If you're getting 1.5 to 2 points on the first retry and then dropping that by about half to 2/3 with each of the subsequent retries, by the time you get to that fourth retry, you're getting 0.1% return. That's about the time that we advise most of our clients, okay, you've wrung the washcloth dry, it's time to turn off these subscribers. So this is kind of a classic example, a classic slide, if you're looking at how that should work. And now it's time for our next polling question. So I'll turn it back over to you, John.
Thank you very much. All right, polling question number 2. I'm coming to your screen right now. And here you can see the question is, to what extent has your organization identified causes of involuntary customer churn? So as before, we'll give you 30 seconds, all answers anonymized, etc. And I will remind folks to ask questions as we go, and we'll do our best to get to those during our Q&A portion of today's event. We already have a number of questions, so thanks to the folks who are already asking, but feel free to ask at any time. And I've got a few myself that I'm curious about after all these great stats. All right, we're going to go ahead and close down this second poll right now, and let's share out the results as we did last time. And all right, there we have it. So, gentlemen, what do we think about this? It looks like some folks have done some work on this front.
Yeah, so I would say that this is probably fairly typical. You know, I don't know a lot of businesses that can say that they've identified all causes. I'd certainly like to hear from those folks as to how they've done it. But being able to identify some of the causes, that's probably more the most common scenario. You know, it does take a lot of analysis, a lot of data review to be able to figure out what those causes are. And for each one of those causes of involuntary churn, then the next step, of course, is what action do I take to remediate it? And that is really where the challenge lies, because you know, you can discover the problem, but then, okay, now how do I correct it? Particularly when some of those failings may happen outside of your control, but you now need to take some steps internally to correct the problem. So it presents some interesting opportunities. Okay, I want to talk briefly about some interesting things that other subscription companies are doing to build their portfolio of revenue. These are a couple of different clients that we work with. Several of these happen to be in the over-the-top video space, but there are others in the content area. So on the top left, you've got Yaveo. This is another offering from DirecTV. It is targeted particularly at the Hispanic market. It is a collection of all Spanish language video content. So think about movies that are either originally authored in Spanish or have been subtitled or dubbed into Spanish. Telemundo and various other channels that you might want to get. Making it available to people on an internet-connected device. What DirecTV has done that's very interesting here is that they, from the very beginning, zeroed in on the fact that they needed to do this in a way that was accessible to that group of customers that they were trying to reach. They have it so that you are able to, the entire interaction is in Spanish. That should seem intuitive. You'd be surprised how often it's not. You've got to offer the products in the language that your consumers are going to be working in. So if you know that it's all Spanish language and you want to offer in Spanish, if you are offering a product on a global basis, then you want to make sure it is available in all the different languages that your customers might speak. Likewise, all of your written communications need to be able to be delivered in those languages. So, one of the things that we do with our clients is all those email templates that they send out, we offer the ability to tag those and have them in whatever language they want them to be in. So that successful sign-up email that goes out, when someone comes along and signs up for the service, gee, thank you very much, Lars. Thanks for signing up for the service. And by the way, this whole message went out in German, right? Because that was what is appropriate to that subscriber. Yaveo does a great job of doing offers in the language that is appropriate, and they also do a nice job of accepting the payment methods that are most important to those consumers. Particularly with global offerings, you need to be aware that credit cards are a significant chunk of global e-commerce, but they are not the only game in town. If you are offering service in Brazil, as an example, Boleto Bancario accounts for more than 40% of all the online commerce in Brazil. Similarly, in Germany and the Netherlands, ELV transactions are the preferred transaction for most consumers, with that accounting for more than half of all e-commerce. You've got to offer payment methods. You have to accept payment methods that are appropriate for the markets that you're trying to get to. Cosmo Body is an offering from Hearst. It's a fairly interesting way for them to monetize on content they already had. They do produce Cosmopolitan magazine, which is still a very widely read title, particularly in the Midwest. What they have done with this is offered a subscription access to content that's both in the magazine and then some additional videos and other information. Both they and Presto, which is an offering in Australia being jointly offered between Telstra and Foxtel, both of them are doing a great job with promotions. They're offering the ability, they've got coupon codes and discount codes that they'll offer to induce people to sign up, whether it's for a 30-day free trial or the first 2 months at 50% off. We work with our clients on a regular basis so that they are out there offering, taking advantage of promotions and offers so that they can get more people in that front door and then be able to retain those folks over the long haul. That's it for the formal portion of our slides. Definitely would love to hear from folks as far as any questions that they might have that we could answer today.
Great, and we do have some questions here, which I'll go ahead and start out. I will remind folks you can ask questions as we go. So up front, Mark, you were talking about metrics, and I had a number of sort of profitability metrics and churn and others. What do you recommend, and as a CFO, I guess this is especially germane, when you have a sales-driven CEO who is not as focused on customer profitability, but maybe other things like just the raw number of customers or maybe, particular category of customers. Is it, appropriate to push on profitability or, hey, this is not a profitable customer, or how do you even consider having that conversation, and what's your strategy?
Well, it's an interesting question, and I think if you're the CFO, you should have some insight as to what's driving the CEO, but you also have an audience with the board of directors. And having an open and honest discourse with members of your board to ensure that that everyone around the table is in lockstep around what the goals and objectives are of the company at that particular stage of development is critical. I understand, being a CFO myself, the focus on the bottom line. But there will be times where driving top line growth may be a metric that's more important, and if your investors are all aligned in that regard, it's good to know about your profitability challenges, but understand that there may be a bigger goal in mind. And sometimes this affects folks that work on the finance team, because they're so passionate about what they do, and they can see the challenge that's set forth ahead. If that's the case, I think those folks just need to make sure that they're beating a drum, not too loud, not too frequently, but ensuring that people are thinking about issues that are down the road. Because I think that's the responsibility of the finance department, is not to just follow directions, but also point out opportunities to address in the future.
Hear, hear. And further on measurement, a lot of the SaaS measurements that you sort of generally hear about seem to be average measures, ARPU and average lifetime value, et cetera. Is it, when you have, truly homogeneous offering, does customer profitability come into the picture, and how hard should you be searching for and reporting on that customer by customer profitability?
This is Doug. So I'll say that particularly in a consumer-focused subscription model, you should be able to categorize your subscribers into some big buckets. It'd be pretty rare that you're going to dig down into individual consumers and say, where does this person fit on my revenue curve? But you should be able to look at it and say, look, the folks that signed up for my pro offering, that's $200 a year, and so I'm getting on average $200 a year from this group. I've got these consumers down here at $60 a year, and then I've got these other folks who are occasional spenders that on average I'm getting between $4 and $10 a year from. That might be a normal distribution curve. Now, Mark mentioned earlier the ability to increase revenue from individual subscribers and that ability to monetize somebody's loyalty to your platform. We worked with a gaming company for quite a number of years before they were successfully sold off, where they had whales. They had individuals who would spend more than $5,000 in a month, and their average customer was more in the $14 to $17 a month range. Now, I'll tell you that if you do have that kind of an outlier in your data set, then yeah, you need to have somebody whose job it is to pay attention to those sorts of folks. But by and large, subscription businesses are built on large volumes of data and large volumes of transactions. And so, you don't want to look at it and say, for all my pro subscribers, am I getting a proper return on them? You need to look at the portfolio as a whole and say, am I hitting the revenue numbers that I need to hit to make this a profitable business?
Mm-hmm. And now, Doug, on one of your slides, you mentioned account updater, turn account updater on, but you didn't explain to us what that is. Can you give us a moment on what account updater is? And it sounds like it's sort of generically available across payment platforms, but just give us a little more color on that, if you would.
Sure. Sorry about that. I sometimes forget that that folks aren't always familiar with it. Account updater is a service that is offered by most issuing banks. And you get account updater through your payment processor. What the service does is you can check and see if there's an updated credit card or expiration date for any given card that you have in your portfolio. So if Mark is a subscriber to my service and I'm going to go and bill his credit card, I can check and see, does he have a new credit card number or did his expiration date change? You ask the service responds to you and tells you, yep, here's Mark's new number. That can come about in a couple of ways. If there's a data breach, then he may have been issued a new credit card. Or if things went along fine and his card just hit the expiration date, his bank sent him a new credit card. Either way, as a merchant, I need to know about those things, and account updater is the mechanism by which I do that.
Got it. Perfect. Thank you very much for demystifying that. Okay. Well, here we are, just a couple minutes to the end of today's program. We want to make sure we get everyone back to work on time. So we're going to go into our few final housekeeping items here. First off, thanks to the speakers. Great job today, gentlemen. And really appreciate gaining your insights. So thanks so much for joining us.
Thank you. We really appreciate the opportunity and hope it was helpful to all the folks that are on the line.
I know I learned a lot. I'm hoping everyone else did and expecting. We're getting a bunch of thanks through the Q&A here, so I'll take that as a proxy. Yes, please do, folks, join us on performative.com. Continue the conversation with your peers in the community. A lot of interesting subscription-related issues, payment-related issues. It's all part of the fun and games here in the finance organization, so do join us for that. Also, if you'd like an introduction to today's excellent speakers, Doug and Mark, please let us know in the post-event survey. We're more than happy to make those connections. Also, if you'd like to connect with Vindicia and ask for more information about their platform, you can also do that via the post-event survey. It's quick and easy. And speaking of Vindicia, we'd like to thank Vindicia for their commitment to thought leadership in this realm and helping us put on today's educational webinar, delivered at no cost to all the fine folks on board today. So a hearty thank you to our sponsor, Vindicia, today. We're going to go ahead and launch the third and final polling question, which I will do right now. There it goes. What is your company doing to save clients? We did a lot of talking about saving clients today. Curious what other folks are doing. And we're not going to have time to discuss this one like we did the others because we are running short on time here, but I will shout out the leaders as we get through the voting. I do want to take this opportunity to thank everyone for joining us today. We hope to see you again real soon on performative.com or at another performative event like this one. We appreciate how busy you are, and thanks so much for giving us your hour today. All right, leading item here, combination of the above and of the items above, maintaining a saves team is actually the leader. So thanks everyone for that. At this point, we're going to let you all go, so we'll shut it down. You'll be taken right to that post-event survey. Thanks again, and have a great rest of your short week here and weekend. Take care, folks.